Hi. In this video, we're going to take a little bit of a look at the stock market reaction to the coronavirus pandemic. It started in January 2020, primarily in China. And since then, it has gone pretty much global, with some countries getting hit fairly hard and some countries getting hit less hard. I'm going to focus primarily on the US reaction to this. But what this is going to do is just present a little simplified version of why stock prices have responded. Now, I want to add a disclaimer. This is going to be a two-part video series because the second part is going to be probably a lot more realistic and give us a better incorporation of how stock prices should respond to a situation like a pandemic or anything else that causes a major disruption in the markets. So this simplified version, we're going to start with something that's probably pretty familiar to everybody that's had a business finance course, and that is the constant growth pricing model. The constant growth pricing model just says that the price is equal to the dividend in year one. And here we're saying the dividend in year one is the current dividend times 1 plus the constant growth rate divided by the required return minus the growth rate. And this is sometimes called Gordon's growth model or the constant growth model, and it's based on dividends. Now, a disclaimer. This is not a model that gets used a lot in practice. It's not something that stock analysts say, let me pull up the Gordon growth model and figure out what a stock is worth. And there are a couple of reasons for that. One is stock prices are based more on free cash flows than dividends. Dividends are the cash flows that get paid directly to stock investors. However, a lot of companies don't pay dividends. Maybe they're growing rapidly and they're reinvesting their cash into the company. Maybe they're just not somebody that believes in dividends. They want to have management reinvest the capital, or maybe they're doing stock buybacks instead of dividends. The point is, for a lot of companies, it's not dividends that matter directly, but free cash flows. Another big problem with the constant growth model is, as the name implies, it assumes constant growth. Assumes companies are growing at the same percentage rate each and every year. So if they're growing at 3% this year, they're going to go at 3% next year. They're going to grow at 3% in year 2, year 3, year 4, year 5. We're not going to grow at 5%. We're not going to grow at 1%. We're going to grow each and every year at the exact same rate of 3%. Now, if you know anything about economics and company growth, you know that companies do not grow at the same rate forever. Part of that is due to competition, new competitors coming in, competitors leaving, regulatory changes. Part of it's due to just the economy. The economy doesn't grow at the same rate every year. So this is a very simplified model. It's not really designed to say, here is the value of a stock, but it really helps us understand what things drive stock prices from a big picture perspective. Think of this as the 30,000 foot overview. What's going to drive stock prices? And those are going to be three things: the cash flows that we're going to receive. Here we're representing the cash flows by the dividends. The growth rate, how fast is the company growing? And the required return. How much are investors demanding as compensation for investing in this particular stock? Those are the big three factors or levers that are going to drive stock prices up and down. Now, in our model, we're going to use another academic theory that is somewhat questionable at this point, and that may be being generous, and that's the security market line. The security market line kind of came into finance in the 1960s and 1970s, became very widely accepted and mainstream, but over the last 20 years has been widely discredited. There's some concerns about beta not being very predictive. There's concerns that other factors might help explain stock returns beyond beta. So right now, this model is not near as widely accepted as it was in, say, 1990. or 1995, but it's still something that is pretty much a standard part of every business finance course to help us get a concept of required return, what investors are demanding based on the risk of the stock. So let's start with a baseline. Our baseline is we're going to assume the 10-year treasury is the risk-free rate. Again, that's somewhat questionable. There is no truly risk-free asset. Some people argue we should focus on a 3-month treasury bill. Some people argue the longer term. I'm in the longer term camp, as stocks are a longer term investment. So I use 10-year treasuries as a proxy for the risk-free rate. Again, it's not truly a risk-free rate. There is no truly risk-free rate out there. So this is just an approximation. We're going to say that's 2%, which is about where it was in the US before the coronavirus concerns started to materialize. We're going to assume a beta of 1. Beta of 1 implies an average risk stock. It's not riskier than the market. It's not less risky than the market. Instead, it's going to move about on par with the market. All else equal, if the market is up 10%, we'd expect our stock to go up 10%. If the market is down 10%, we'd expect our stock to fall 10%. And I should note that is talking purely about market risk. It's not getting into firm-specific risk factors like what happens if the company has product failure or a huge product success or things like that. So beta is looking at market risk, just how sensitive is the stock to the overall market. And we're, again, just going to assign an average beta of 1. And finally, market risk premium. We assume stocks are riskier than bonds. And that makes sense because especially the risk-free rate is supposed to be no risk. Stocks have risk. One, companies can go bankrupt. And if they do, stockholders aren't going to get all their money back. Even if the company doesn't go bankrupt, their success can go up or down based on the products that they're doing, based on their competition, based on management decisions. A whole lot of factors can influence that. And so we would expect stocks to be riskier than a risk-free rate. And the question is, how much of an extra premium do investors need to compensate them for that risk? In finance, one of our big assumptions is that investors are risk averse, so that they need additional compensation. And studies have indicated that this probably ranges somewhere about 4 to 6%, maybe sometimes a little bit lower, maybe sometimes a little bit higher. I'm just assuming 5% as a baseline. Again, this is just an assumption point. So we're going to change these as we move through. We're also going to assume the current dividend. The dividend that was just paid over the last year was $2. Just picked a nice round number to make the math easy. And a constant growth rate of 3%. Now, one thing to keep in mind about this constant growth rate. Overall, the growth rate for a company cannot be constantly faster than that of the overall economy. Now, the overall economy grows at different rates at times. So 3% is probably on the high end. You might argue that the US economy is probably in a more 2.5% growth rate. Again, it's just a starting assumption, so let's not get worried about that. But in general, be skeptical anytime you see a growth rate of 6, 7, 8%. Those are fine in textbook examples, but you're not going to see a company grow at a constant rate of 6% forever unless the economy is growing at 6% as well forever. And that's just simple math. If a company continued to grow at a rate twice as fast as the overall economy, after a certain point in time, it would be the economy and it would still have to grow faster. So what? We're going to start seeing it expand to Mars, Jupiter. You're not going to see that happen. So our constant growth rate should be relatively small, somewhat in line with the overall economic growth rate. Okay, we've got these numbers. Now let's do some quick math. So we're going to go ahead and calculate the price of the stock. That is equal to $2 times 1.03 divided by the required return minus the growth rate. So we're going to need to go up here and figure out what's the required return. So our required return is equal to the 2% plus our beta of 1 times the market risk premium of 5%. It's going to give us a 7% required return. So we plug that in, minus our 3% growth rate. And that's going to give us a value of $2.06 divided by 0.04. Get out my calculator. And that gives us a value of $51.50. So that is what the stock is worth at our starting point. This is before the coronavirus scare comes along. Now, when the coronavirus scare comes along, two things happen simultaneously. One is all of a sudden the economy is slowing down. We're getting shelter-in-place orders. We're telling people only essential businesses should be open. And so all of a sudden that 3% constant growth rate, that's not going to happen. So investors start to say, well, maybe we should lower that constant growth rate. Maybe instead of 3%, it should be 1.5%. So let me go ahead and just change our growth rate. So now growth, we'll call it growth prime, is equal to 1.5%. Another thing that's going to happen, and we've seen happen, is the treasury rate's fallen a little bit. That's all else equal a good thing. That's going to lower the required return. So let's go ahead and put that in. The risk-free rate now, let's say, drops to 1% instead of 2%. And the market risk premium. All of a sudden, we went from seeing stock prices that maybe went up 1% on a good day or down 1% on a bad day. All of a sudden, today, as I'm recording this, the market was up like 10 to 11% today. Previous days, we've seen it drop 10 to 11%. Market volatility has just gotten crazy over the last couple weeks. Again, I'm recording this on March 24th, 2020. So if we look back over the last 2 to 3 weeks, we've had more 5% swings in the market than we have over the past several years. And this is something that causes people to say, hey, things are a lot riskier than we thought. That 5%, that's not enough. Stocks are a lot riskier. So now maybe we change that market risk premium. And my formatting's probably not going to be quite as nice here, but change that market risk premium to be, say, 7%. Now let's redo our calculations. Price is equal to $2. It hasn't changed the last year's dividend. What it's going to do is change the growth rate. So now we're going to multiply by 0.15. Also, our required return has now changed. So let me go ahead and change that. The required return is now equal to 1% plus 1 times 7%. All of a sudden that bumps our required return up to 8%. And remember, our growth rate is 1.5%. So now let's do the math again. So our new dividend is now going to be $2.03. And we're dividing by 0.065 now. 2.03 divided by 0.065, and all of a sudden the stock price is $31.23. Okay, so how big of a drop is that? Well, the stock price is now $31.23. It was $51.30. 51.50. So that is our change divided by the starting point of 51.50. And that's a drop of 39%. Better make sure I put that negative sign in there. Stock prices didn't go up. That's a decline of 39%. So how big has the stock market drop been? Well, if I jump back to the market highs, the Dow was at 29,555. The low point yesterday, we were down around 18,000 something. I'm going to call it 18,200. That might not be exactly right. Let's just go with that. Minus, I think we were at 29,500 was the top, something like that. And when we do that calculation, we see a 38% drop. Now, quick side note, I did not do these calculations ahead of time to figure out that that was going to be exactly the same level. I kind of just winged this on the numbers, but essentially this is what was going on in the markets. Markets were saying, hey, stocks are riskier than we previously thought. Growth is lower than we previously thought. Let's adjust based on that. So you can see here, we start with a constant growth pricing model, a security market line. We get a required return. Stock price was worth $51. Now it's worth $31.23. That would be a 39% drop. And at the low point, we saw a 38% drop. Now, I'm just going to do a quick check here of what the Dow is. And the Dow closed at 20,704 today. So if I update that, 20,700, I'm just going to round it off, minus the 29,500. Divided by 29,500. And that brings us to about a 30% drop in prices. So based on today's information, hey, maybe people are saying we might have overreacted a little bit on the growth rate. Now tomorrow is going to be a whole nother story. We could go up from here, we could go down, but the idea is markets are constantly evaluating required returns, they're constantly evaluating growth rates, and that's going to cause prices to bounce around. So when you see stock prices jump up or jump down, that's because investors are trying to deal with all this information, figure out what's going on, and factor that into their stock prices. So we're going to wrap this up. And again, remember I said this was going to be part one. Tomorrow I'm going to go ahead and film a little more complex version to look at a more complete discounted cash flow model. And we'll take a look at how that impacts market valuations. What we're probably going to find is that depending on your assumptions, the market reaction may be a little bit too negative. But then again, a lot of that's going to depend on how quickly you think we're going to recover from this. Is it a short-term issue that's going to affect growth this year? Or is it something that might have an impact over the next couple years? At this point, no one knows. And that's one of the things that makes stock markets interesting. So thank you for your time, and I hope you found this helpful.